but it is all about earnings. Edelweiss is the one which is on our radar. Reported an overall strong quarter. However, the net loss for the quarter for the insurance company had widened. So, to discuss the company's performance going forward and in the quarter that went by, we have the chairman, Mr. Rashesh Shah, joining in. Thanks a lot, Rashesh, for joining in. First up, if you could tell us how exactly was the performance of your ARC business, given the sort of resolution news that is flowing by. Earlier, one of your peers also reported their numbers. The ARC business was the one that really performed well. So, are you looking at any partnership there and the performance of your ARC business?
As you can see, overall, we have clocked about 46% growth for the quarter as well as for the year. So it has been the best year ever for Edelweiss from a growth in profit point of view, because we have been averaging our profit growth rate at about 35 to 40%. But for this year and for this quarter, it's about 46% growth rate over the same quarter last year and FY18 over FY17. Our ex-insurance profit after tax for the year is now 1,036 crores. Out of this, approximately about 12 to 13% comes from our ARC business. So ARC is about 12 to 13% of Edelweiss profit contribution. ARC has also grown. So the ARC as a whole, last year to this year, there is almost 80% growth in profit. But as you know, we own only 60% of the ARC business. We have a partner called CDPQ, which is the Canadian Pension Fund. They have another 20%, and the other 20% historically is when we started the company, we had given to some of our high net worth investors. So we own 60% of the ARC business. I think the ARC business has clocked a profit after tax of 188 odd crores, and 60% of that flows through into our profits, so it comes to about 120 crores or so. And our overall profit for this year consolidated is 890 crores, and excluding insurance, because we are still in investment phase in insurance, it is 1036 crores. So we've crossed 1,000 crores of ex-insurance profit for the first time, and this is a big breakthrough for us. So 46% growth in profits, but also crossing 1,000 crores of profit after tax ex-insurance is a fairly important achievement for us.
Mr. Shah, just a moment, wanting to divert a little bit to MRF numbers which are flashing for you. While it's looking good on a Y-on-Y basis, this is actually, I think, lower than what the expectation was, because the Kotak estimates that we had actually pegged profit at about 380 odd crores. In terms of EBITDA, the number was close to about 750 crores, so at 680, it's definitely a bit of a miss. Margins as well have improved on a Y-on-Y basis, but it's much lower than the 80-19% that the street was expecting. So it was expected to be a very strong quarter. The expectations were very, very high, and it looks like it's a bit of a miss on that. We'll wait by and see what the realizations are. But for the moment, let's get back to chatting with Mr. Shah about the Edelweiss quarter. Mr. Shah, I was hearing your press conference just a short while back where you've spoken about the growth for your NBFC business, which was at some 38% CAGR, right, over the last 20 quarters. But a lot of that was when you were small. I mean, the business was smaller in size. Are you confident of this kind of growth, given the kind of size that your lending business now has?
Yeah, it's an important question. Over the last 28 quarters, we have clocked in a profit after tax of 38% CAGR. But what is important to note is, in this 28 quarters, the last 4 quarters, which is the year FY18, we have clocked 46%. So in fact, there has been some acceleration in that. But I think going forward, what we have always guided investors is we want to have a long-term profit growth rate of between 25 to 35%. And for the last 5 years, we've been guiding investors on that if you can maintain a profit growth rate of 25 to 35, in some good years, we'll do more than that, like in this year where we got 46% growth. But our aspiration is to be in that 25 to 35 consistent, steady year after year growth rate.
Right. Mr. Shah, let's also speak about your insurance business. What was the 13-month and the 61st month persistency ratio for your insurance business?
For the 13-month is the one that we calculate, because as you know, we're growing fairly fast.
Right.
We are around 78% on a 13-month persistency, which is also all-time high. A year ago, we were at 72. But 3 years ago, we were at about 58, 59. So we have improved from 58, 59 to 78% now on a 13-month persistency on that business. Even our insurance business has had a very good growth quarter. In fact, for Jan and Feb, our insurance company was the fastest growing insurance company in the insurance industry as a whole. And we have clocked about 54% growth in APE for the insurance business. And overall, our total gross premium this year has crossed 638 crores. So insurance business also over the last 5 years has clocked about approximately 40% growth, but this year has been more than 50% growth on that business.
All right, Mr. Shah, before we let you go, there are a lot of murmurs on the street. Any inorganic growth opportunities? There's a gold finance company on the block. Are you looking to buy it?
We are always careful what we communicate with investors. If there is ever anything that needs to be communicated, we'll be usually the first one to announce it and talk to investors. As of now, there is nothing that we need to announce from an inorganic growth opportunity point of view. As you know, there are a lot of opportunities come. Everybody evaluates all the opportunities.
But you're interested in the gold finance
space, we have not progressed
right?
on any opportunity to the stage at which we can announce it to our investors.
You're interested in the gold finance space, right?
We are interested in growing our credit business. Currently, our credit businesses are growing fairly well. Our SME business, our entire retail credit business grew at 81% in this year. So SME, mortgages, agri credit, they are growing fairly well. We are currently not expanding the product portfolio on the retail credit business. The products we have, we are fairly happy with that. And we see a lot of growth in this product verticals in the coming years.
All right, Mr. Shah, we'll leave it at that, sir. Thanks very much for joining in and for taking us through your quarterly performance. I think MRF...